As we start Module 26 of the Series 65 and 66 session, let's go ahead and look down towards the bottom of page 39. And where we are is at the benchmark portfolios for comparison of performance. Anytime that we do something, that's cool, but what would happen if we just emulated a portfolio, an index? That's really what we want to look at. When we look at investment managers in particular, how well did they outperform? Outperform what? Outperform, one of the common comparisons is an index. And so for large capitalization, big companies, we want to use the S&P 500. For small capitalization stocks, typically we'll compare to the Russell 2000. I would remember the name of that index and I would associate it with small capitalization stocks. So S&P associated with large cap, Russell 2000, small caps, okay? And other portfolios use indices which most closely resemble the securities held. So that if you're a treasury manager, you'll compare yourself to a treasury index or a corporate bond index. If you're a corporate manager, the one that's on the next page, on page 40, is the EAFE for foreign securities. Europe, Asia, and the Far East is what that stands for, and I would be familiar with that acronym as well. The next thing we have is Sharpe's formula, or the Sharpe's ratio. You might see that. What we do is we take the actual return minus the T-bill rate divided by the standard deviation. That first part, that sounds familiar, okay? Let's see if we don't recognize this from a previous module. I bet we do, because what we want to do is that we want to take, let's see, what is it again? It's the actual return. So here is our total return, okay, minus the T-bill rate. So there's the T-bill. Now what did we say about T-bills, the 90-day T-bill? It's kind of the benchmark for a risk-free invest. Oh, wait a minute, now it's starting to come back, isn't it? If we take the whole thing and subtract this out, we've got our risk premium. There we go. And what do? We divide that by the standard deviation. And what do we say about standard deviation? It's the volatility of. So the volatility on its own. Now let's look at this, okay? Let's just use some round numbers. Let's say that our risk premium is 10. And let's say that my standard deviation, I have a really, really tight standard deviation. It's 1. There's my bell curve right there, okay? I mean, it's just super duper tight. Low volatility, high predictability, that means that my Sharpe's ratio is going to be 10. But now, let's compare it to something else, okay? Let's say that we have a standard deviation of 5. What does that look like? Boom, it looks like so. Those returns are all over the board, okay? Oh, I hope I didn't write too low, but it might have. Let me do that again, okay? There we go. We'll put it up here. That's a little bit better curve anyway, all right? So basically, our yields are going to be all over the place. We've got a lot of volatility, not much predictability, because we've got a standard deviation of 5. 10, which this didn't change. What changed was, right there, we've got a Sharpe's ratio of 2. Now, Sharpe's ratio is kind of like the knives in your drawer. The sharper the better, right? Yeah, that's it. Because what is it? What is, let's just put this into common terms. Basically what we're doing, if this is the bang that we get for taking a risk, how much risk did we take? Well, right there, or right there. So the Sharpe's ratio measures the amount of bang we get for the volatility buck that we take, that we have to pay. Okay? So basically that Sharpe's ratio, it's that risk premium divided by the volatility of that actual investment. Higher the better. It means that we're getting like I say, the most performance out of the least volatility. Okay, the Monte Carlo simulation, I've heard time and time and time again that there's a question on the test on this, okay? Now, problem is with Monte Carlo simulation, when I think of Monte Carlo, I think of the Formula One race and I think of casinos. I can't make a comparison to Formula One, so I'll go to the casino. Unfortunately, my favorite game is roulette. One time, I spent about 2 or 3 hours on a spreadsheet, and I finally figured out roulette. You have a 1 in 37 or 1 in 38 chance of getting a 36 to 1 payoff. That's the whole game. That's it. There's nothing else. Okay? Very, very predictable. You know, I just like it for all the sensory things, you know, croupier, no more bets, things like that, watching the ball. But in any event, don't go to the roulette wheel, okay? What you want to do is to go to the poker room. Now, you've seen it. You know, they have the Texas Hold'em tournaments, and you've seen it. It shows what they've got, you know, that are their down cards, and then they do, I can't remember all the terminology, but they turn up those first cards, and what happens? Well, first of all, when there are two people that are playing, it'll assess those two cards and it'll say that this guy has a 46% chance of winning, this guy has a 54. Somebody else decides to play, all of a sudden those things change. Why? Because there are now new variables. And then they lay the cards down. Boom, all of a sudden it recalculates those expected probabilities of winning. And every time that something happens, it reassesses and reevaluates the probability of winning. That's more like Monte Carlo simulation. Basically what you do, and we can do this like thousands of times now that we have computers that can go back and just do those calculations just instantly, or pretty much instantly, is that what we do is that we project out the probability of obtaining results, certain results, given different sets of circumstances. So just think of the Texas Hold'em tournaments. And like I said, that's it. And calculating probability of achieving certain returns under different investment circumstances, that is just about what you're going to see on the correct answer. What is it? Okay? And that's what we do. And we'll, like I say, especially with with asset allocation and putting in, introducing volatility, introducing stability, introducing bonds versus stocks versus the different asset classes we can have. That's where we use Monte Carlo simulation a lot. Okay, then the types of risk that we have, already talked about these. Market risk is systemic or systematic risk. You have to hedge with index options against this. Buy an insurance policy on the whole market. It's the only way to protect yourself. Okay, or just if you're lucky, you can get out. But basically, like I say, you can use index options. The underlying item, it's not a security, but the underlying, what underlies those option contracts is the market as a whole, depending on how you define the market as a whole. It is also, market risk is the basis for the capital asset pricing model and the expected return from that. That measures a systematic risk, and that's just a term that I'd be familiar with as well. You also have unsystematic or non-systematic risk. That's the business risk or selection risk. You've heard it. The guy says, oh man, there are like 20 companies that were doing this, and wouldn't you know it, I bought the one that, they went belly up. The guy absconded to Argentina with all the money. You know, well, what would have happened if you'd bought, a little bit of all 20 of them? Yeah, you would have been hurting only 5% as much. Diversification helps that selection risk or the business risk. Diversification doesn't help the systematic or systemic risk because it's just like a boat. And if the tide's going down, all the boats are going to go down with it. Okay? So anyway, that's systematic, non-systematic, or unsystematic risk. Inflation or purchasing power risk. It's present in all, count them all, fixed income securities. There may not be default risk on treasuries, but there's still inflation risk because it'll buy less and less. In order to get away from it, what you have to do is that you have to go variable or go to something that indexes in for inflation, like TIPS bonds. The Treasury Inflation Protection Securities is what that stands for. So you want inflation protection? Get Treasury Inflation Protection Securities. That's one way to do it. Or variable, like with stocks. Okay? So in any event, your raw return minus inflation, remember that's your real rate or inflation adjusted rate. And over time, inflation will just eat away at what that dollar that you get from a particular investment will buy. And if that's all it kicks out, because it's a bond and it's paying you $50 a year, and that $50 a year buys less and less as time goes by. All right, then we also have interest rate or money rate risk, and this is it's the little teeter-totter that we've drawn on bonds. I don't know how many times. Interest rates go up and bond prices go down. Because if I have a 4% bond, but now the market is expecting 8%, my bond's only half as attractive as a new bond. Okay? Therefore, I have to discount it down to where it gets a yield to maturity of 8% to compete with what's new and coming out of the marketplace. If I buy an 8% bond, but interest rates go down to 4, oh, hey, I said, hey folks, I got an 8% bond for sale, and you ought to see them line up. You get 8% on that thing? Yeah, but you're going to have to pony up for it, because I'm just not going to sell it at its face value. Okay? It's in more demand. You also have credit or default risk. And again, diversification helps you out. Moving towards investment grade securities helps you out. Treasury securities, government agencies, that will help you out. Blending those in. If you want some of the higher risk bonds, but you want to minimize your credit risk, be sure to blend in those investment grade bonds with it. Let me make sure that we're clear on the terminology here. Okay. Moody's and Standard & Poor's rate bonds on the following scale. Okay. They start out with the best bonds are AAA. This is the Standard & Poor's terminology. It's almost identical on Moody's. So anyway, AA, really good. Single A, very good, very good. And then you have triple B. Moody's goes BAA. Okay, right there. Anything below that line is not investment grade. It's junk or high yield securities. Okay. But up above this is investment grade. This is what institutions, folks with a fiduciary capacity, they can buy these investment grade securities. Well, like I say, if you want to minimize the credit risk or the default risk, you stay with these or blend those into the higher risk bonds, and it helps to diversify out from there and to minimize that risk. Now, not to say that a bond can be AA rated, next thing you know, boom, they're underwater. It happens sometimes, unfortunately. But again, this is to minimize that risk. You go with the better grades. Regulatory risk, laws, and especially tax laws, are changing all the time. One of the things that we don't get into on this one because it's just too deep, we talked about those real estate partnerships, okay, the direct participation programs, and how they can throw off losses because they report on K1s. At one time, those losses would offset ordinary income. And the only question people would ask, what's the write-off? You know, there are people who wouldn't buy one of those programs unless it had a 6 or 7 to 1 write-off. Boom, Congress said, this is all wrong. This isn't the reason that we have this in place. We're going to set up a different set of rules, and you can't just claim that. Guess what? There are a lot of folks that's been, oh my goodness, that's been many years ago that the rules changed. Probably some people are still carrying forward those tax loss carryforwards, the passive loss carryforwards, to this day, because they were loaded up to the eyeballs in these things, and they were making their money from tax savings, not from the business that they were getting into. Laws change. Tax rates change. You have to be very aware of that. There's no law that says municipal bonds are tax-free. Now, if that changed, I will be more surprised than anyone. But still, like I say, there's no law that says that they are tax-free. So that's regulatory risk. Liquidity risk. You can minimize your liquidity risk that I can't sell what I've got at a reasonable spread. Remember we said that the difference between the bid and the ask? We can wind up taking a haircut if we try to sell something that's very illiquid, like one of these partnerships. Well, blend in things that you have some treasuries in there. Man, treasuries are like they're the poster child for liquidity. And so you blend in the larger names, higher traded, more activity, more demand in the marketplace for that particular security in general. You'll be able to get out of your securities, maybe not all of them, but probably enough to cover the cash need that you have pretty easily. Then we have types of client ownership, liability, and taxation. How do we set up the accounts? Of course, we have an individual, kind of sets the baseline for us, okay? And by individual, it's just a single person, has total responsibility for all the taxes in the account, and an individual has unlimited liability. Anybody can sue anybody for anything at any time. And if there's something that does not protect that person, then they can literally wind up losing their house, their cars, their everything they've got in a lawsuit. Okay, so an individual, like I say, that's kind of our baseline. The next thing you have, and this is just kind of a variation of this, is a transfer on death account. What I like to do is I like to compare that to, you remember what Aunt Millie did? She put masking tape on the back of all of her stuff, and she says, my little nephew Billy gets this and my niece Susie gets that when I pass away. That's what you do in a more rigid structure on a TOD account. Because what was the deal? Okay. There's the security, and you flip it over on the back, and what does it say back over here? My little nephew Billy gets it when I get it, when I pass away. But who owns it? Aunt Millie owns it. Her name's on it. Billy, it doesn't do anything. He doesn't have any evidence of ownership. Billy tries to call you up and say, hey, I need to sell this for Aunt Millie. But I'm sorry, Billy, you don't have a power of attorney. Yeah, but I'm going to get it when she passes away. Doesn't matter. Is she dead yet? Well, no. But then, doesn't matter. But when she dies, then it's like a beneficiary designation, and it'll go straight to him. Won't have to go through probate because she has that little piece of masking tape on the back of it. Says, I want Billy to have this when I pass away. So there's the TOD. You have an UGMA or an UTMA account. Uniform gift to minors, uniform transfer to minors. Small differences between the two. You won't need to know the difference between those. Just know that everything in there has to be done for the benefit of the minor. All right, benefit of the minor. The custodian has to be an adult, but you use the kiddo's social security number. The kiddo therefore gets the 1099s. All right, the kiddo actually has the tax responsibility. Now what's going to happen? The custodian, dad's going to write out a check if it's that much, if there are any taxes due. But this is not real world. This is test world. And in the test world, what do? You look at the 1099. Whose social is on there? It's the child, the minor. Okay? And so therefore, the minor has the tax responsibility. So that's an UGMA or an UTMA account. Any unearned income over $1,900 though is taxed at the parent's marginal rate, and that may have indexed up. So be sure to check the dollar amount. The important thing is that once the child reaches a certain level of unearned income, now if little Billy, he's 14 and he starts mowing lawns in the neighborhood and he makes $10,000, $12,000 over the course of the summer. He's a hard worker. That's earned income. But if his investment income hits that threshold, all right, then anything beyond that is going to be taxed at the parent's rate, and that's just designed to discourage parents from making kind of faux gifts that they take over then later on. They revoke those gifts. A joint account, you have a couple of different types. Joint with right of survivorship. And basically what happens here, the name is very descriptive. You have, there's Fred and Millie, joint with right of survivorship. They both own it jointly. It belongs to both of them. Either one of them can make decisions in the account. But when, let's say that Fred passes away first, boom, it transfers over to Millie. As opposed to tenants in common. There's Fred and Millie. Tenants in common. Now they both own it, jointly. They can both make decisions in it, but if Fred passes away here, now what happens is that Fred's part goes to Fred's estate, and Millie's part reverts over to Millie. And drawing the boxes about 50-50. It can be any percentage. Partnerships, we use that a lot. Okay? They'll use tenants in common. All right, then maximum capital loss write-off in any year is $3,000, and what we'll do is that we'll carry forward the balance. So let's say that we had a really lousy year, okay, and what we did was that we took our capital gains. We did have about $4,000 in capital gains, but we had capital losses of $9,000. Well, we subtract the two, that means that we have a net capital loss of $5,000, and you may need to do this math, okay? What we'll do is that we'll go over here on our 1040 and we'll take $3,000, and again, double check the dollar amount because that's what we call that regulatory risk. Tax laws can and do change, all right? So anyway, we'll take $3,000 off of our income, but then minus $3,000, that still leaves us with $2,000. And what we'll do is that will be a capital loss carry forward. And if this is $12,000 or $15,000, we can carry it forward as long as it takes until we get to use it. So there's a capital loss that we can write off. And then wash sales are going to negate tax losses. Here's what we've got is that we've got a security that we bought and it went down. Now we like it longer term, but we've got some capital gains that we'd like to offset. So what we do is that we decide that we will sell it right here. If we don't wait 30 days, then basically what happens is that any time that I buy in through here, buy it back, that's a wash sale, and my loss will be disallowed. Okay? Now it doesn't go away, it just gets added to the cost basis of my new stuff, and do the math on it, that's why it's called a wash. Okay? So I might as well not have done anything. If I wait till here, okay, and I buy it out here, then that's okay because my loss is allowable there. Why? Because this thing could have actually, while I was out of it, it could have actually taken off without me. So I'm at risk, and 30 days is an okay time period. So I said, you know what, I'm gonna outsmart the IRS. I'll double up on the thing, and then I'll sell my original shares, and that way I'll never have to buy those things. No, doesn't work that way either. You go 30 days back this way. Now, if I bought it in through here, that's okay. Why? Because now I've got double the amount, and it could do that, and I'd be hurt twice. And 30 days is long enough to be at risk for that happening. But I've got to wait 30 plus my trade date. That's a 61-day window that I've got. And so either side of that date that I sell, I've got to wait the 30 days. Otherwise, like I say, my loss is disallowed because it's within that 30-day window. Like I say, 61 total. And then you have a line item that says substantially identical securities. So I say, I'm not going to buy the stock. I'm going to buy a convertible bond. No. I'm going to buy an option. No. Let's see, what do we say about put options? If I sell one and it gets exercised, I wind up buying stock. I won't buy anything. I'll sell a put option. No. If there's a string between what it is that you sell and what it is that you buy, where you can go from one to the other, find your way from one to the other, it's the same thing. So there aren't any side doors or windows you can crawl into on this thing, okay, on the wash sale. 30 days plus or minus a 61-day total window. All right, well, I'll tell you what, let's go ahead then and take a break. We'll come back then after the break and pick back up where we were and carry it from there. Hope that this is helping you. Do get in touch with us, let us know, and especially let us know when you pass, okay? Thanks.